So what is financial management? Financial management relates to the management of the financial resources of a business. This includes deciding on how to procure some amount of funds needed, deciding if a company should decide to buy a certain machinery or make some investment, and many more things. Very broadly, decisions relating to financial management include decisions relating to investment, decisions relating to financing, and decisions related to the dividends of shareholders. These decisions can be taken accordingly to try to achieve a certain objective of the business. So what is this objective? The objective of financial management conventionally was taken to be the maximization of the shareholders' wealth or shareholders' value. Here shareholders' wealth or value refers to the market price of a company's shares. Financial decisions are often made while considering their impact on the market price of a firm's shares. By the conventional objective, a financial decision was taken while keeping in mind the objective of maximizing the market price of the shares. But what about the other stakeholders? While shareholders are an important stakeholder, it is evident that there are many equally important stakeholders such as the employees, customers, society, and many more. There is growing awareness that needs of other stakeholders also needs to be considered by firms. And this is very often very complex, as stakeholders have diverse concerns that can at times be contradictory. Now coming to the type of financial management decisions, which were broadly divided into three areas, one pertaining to the investment decisions. Financial management decisions often include assessing if it's worth to undertake certain investments that can help earn returns in the long term while considering the risk. For example, a machinery may be purchased that will help earn returns in the future, and the returns may have some amount of uncertainty or risk associated with it that needs to be considered. This relates to the capital budgeting decisions. There are a variety of methods that can help make such decisions, such as an NPV or net present value, and variety others. Each method has its own advantages and disadvantages that needs to be decided on selecting an appropriate method. Also, short-term needs are to be considered. Appropriate cash and other forms of assets easily convertible to cash that can help meet immediate needs of cash needs to be considered, including needs of certain contingencies. Also, other current assets and current liabilities needs to be considered too. This is a part of working capital management. Both capital budgeting decisions and working capital management come under the investment decisions. Another type of decision under financial management is the financing decision. Financial management also involves in deciding how the required funds to invest or use for some purpose are to be acquired at a minimum cost and to choose the type of financing. Funds can be provided by the owners as shareholders' equity or borrowed, such as through bank loans or bonds, which constitutes debt. Debt has a fixed periodic interest payment associated with it and repayment of the principal after a certain period of time. Shareholders may too expect some amount to be given to them as dividends, though this is not mandatory to be paid by the firm for common type of equity shares. Whether to choose between debt or equity is a question of the capital structure of a firm. Financing decisions also involve trying to find the optimum ratio of financing for a combination of both debt or equity. Depending on different models of financial management and their assumptions, the capital structure is said to be relevant by some and irrelevant by others for the objective of increasing the firm's value, which is the conventional objective of financial management. Another decision relating to financial management is the dividend decision. A firm that has some cash inflows as earnings has to decide what to do with this amount. Shareholders may expect all or some proportion of this amount of earnings should be given to them as dividend, or to expect a future benefit by the increase in the value of shares held by them, to the firm efficiently reinvesting this earnings and earning a sufficient return. A firm may have certain dividend policy to decide the proportion of earnings to be retained by the firm and reinvested or to be given as dividends to the shareholders. And theories are mixed on the impact of this decision on the firm's market price of the shares. Similar to the models relating to the financing decision, depending on the model and the assumptions, dividend policy is considered to be relevant or irrelevant in influencing the market price of shares, the conventional objective of financial management.